Hey everybody, welcome back to the weekly market analysis for the week ending December 2nd. We've got a lot of stuff to talk about today. We'll talk about some of the economic data this week. We'll take a look at the markets, some technical levels. But before we get into any of that, I want to remind you to hit the like button and subscribe to the channel if you haven't already, and send this video to somebody if you think the analysis is solid and you think somebody can benefit from it. And I'd also like to mention that you can follow me on Twitter at Mr. J. Thomason, and you could also, if you're interested, subscribe to my free newsletter, which is released every Sunday morning with just my thoughts and my view on the markets. It's only a little bit, but it's my thoughts and it's genuine, and it's my best look at what's going on. So if you think that that's helpful, you can subscribe to that. But with that, let's dive in. So today, the big question is, as we end this week, is it's make or break time for the markets, and are we ready for what December may hold? And where are the markets going to go from here? And we've had a pretty good sized run up already. If we go from the wick on the S&P, then we're up over 17%. If we just go on a closing basis, then we're currently up 13%, but went up as far as almost 14%. And so we've had a pretty good bounce here. And we're at trendline resistance. This is the key, maybe the most important trend line in the markets right now. This trend line was tested in, we created this trend line back in the end of March on the March bounce. And we came right up to the trend line, didn't touch it, but came up to it back in August on that run up in the summer. And we came up and kissed that level yesterday in trading, but got rejected. And then today's price action, you can see that we traded down significantly intraday, but closed up pretty close to the open. And that was fueled by today's non-farm payrolls report, which came in much higher than the estimate. So the estimate you can see on the page here was at 200,000, but the increase is actually 263,000. The unemployment rate was flat month over month as far as it relates to last month's print. Last month we had a 3.7% unemployment rate, and if you recall, actually last month when this unemployment rate number went from 3.5% to 3.7%, you actually saw the markets react pretty positively on that. So that ended up being flat compared to last month. But then a really big aspect of this is the hourly earnings jumping 0.6%, which was double the estimate, and then 5.1% annually versus 4.6 expectation. And there's a whole bunch of wood that you can chop through if you want to look at the actual data. There's a lot of people that are trying to unpack this and talk about, oh, well, if you account for this different aspect or that different aspect, then the jobs would have actually shown losses, or the gains would not have been quite as big, and people have 2 or 3 jobs and all that kind of stuff. But it's interesting to me and kind of funny that same, this is just, me kind of editorializing here a little bit, but it's interesting to me that same scrutiny doesn't get put into the CPI, which obviously headline CPI came down, and nobody seems to be picking apart that report. They'll pick apart the sections of the CPI that are showing high inflation, but they won't pick out the things that have collapsed that are contributing to the decline in some of those CPI numbers, and the fact that at this point we should not be so concerned about the year-over-year CPI numbers. It should be the month-over-month CPI numbers, and we'll talk about inflation numbers in just a little bit. But I did want to start with that. So what's interesting, and I'm seeing a lot of on FinTwit, I'm seeing a lot of discussion about how great it was that on the initial reaction to the payrolls report, the markets came off really substantially, but were able to fight their way back up. A lot of people looking at that as a bullish sign. It could be. Okay, I don't want people to get the wrong idea that I'm just discounting that and saying, no, it's not going to happen. I do have a bias. My bias says that we're going to head back to the downside. I don't think the S&P will break this level, or if it does, I don't think it's going to be a long breakout. I think it'll be a fake breakout. I actually think max pain in this case would be breaking out above the trend line, because I think a lot of people are watching that line. I've actually, in the last couple of weeks, seen this trend line a lot more, even from like really, not just from your average Joe, but even from really big, well-known accounts. A lot of people are watching that level. And I think that on the breakout, if we do get a breakout of that, a lot of people are going to start piling in. And if that happens, then more likely what happens is we get the breakout, then we get another pretty big up day, because I think that momentum will carry at least a day or two, and then I think we just fall back down. And there's reasons for that. I'll explain a little bit of my bias there on that, but I do just wanted to call out that level. That is an important level that we're at. We kissed that level and have so far been rejected, and we'll see if that rejection holds. We've come up pretty substantially. If you go from the wick, we're over from the low wick down here on October 13th, we're up like 17%. If you just go from closing lows, we're up like 13%. So we've made a pretty good bounce on the S&P 500. The NASDAQ in this bounce has been kind of lagging, made up a little bit of ground on a pretty big up day, almost 5% yesterday. I did see an interesting metric, actually, just going back to the S&P. If you go year to date, then what I heard and what I saw on FinTwit recently was I saw this chart where it talked about in 2022 we've had multiple days where we've had these like plus 3% or more up days in the S&P, and they've or I'm sorry, it talked about in the last couple of years we've had a certain number of like 3% plus, or I think it's either 2 or 3% plus up days on the S&P, and out of all of those, all but one of them have come in 2022. And so there's a lot of truth to the idea that when you're in a bear market, the rallies are ferocious. And I think when I talk about the dollar, I'll go back to that I'll go to that in just a moment. But I do want to just point out that these big up days, a lot of people look at these up days as like, oh, this is the start of the new bull market. But I actually find these to be, concerning, because I feel like, they talk about markets climbing a wall of worry. Those are climbs. They're called climbs for a reason. They're usually like this. They're not usually, giant jumps. So anyway, my point is that just because the markets have had a couple of these really big up days, that doesn't mean that we're going into a new bull market. I think that the size of these counter trend rallies on a couple of these days are warning signs that we on multiple occasions, we kind of overextend to the downside, and so we have that relief bounce. And then plus at every moment along the way, anytime there's even a hint that the Fed could pause or that the inflation dynamics are potentially changing, you're seeing these huge bounces. So I don't think fundamentally there's really anything different, honestly. Like the Fed is going to slow the pace of rate hikes, but they're not stopping the rate hikes. Right now, I think the market is pricing in that the Fed will reach the peak rate, I think in, March. I think the March meeting is when they're pricing in peak Fed, and I believe the market's pricing in 50 basis points at December and 50 basis points in March, and then stopping. And then I believe in late 2023, they're still pricing in either 25 or 50 basis points of cuts. So what's going to be interesting is the dot plot when the Fed meeting happens. Maybe I'll dive more into that in next week's video, but when the Fed meets on the 13th and 14th, not only will there be a fresh new CPI for them to talk about, we're going to see a dot plot from them. And Powell has made it clear that all along, ever since, after the September FOMC, they've made pretty clear that they believe that their their rate hike target is going to be actually higher than it was in the September dot plot. So I'm interested in seeing that. I actually think that that's going to be a catalyst for potentially a crash. I'm not saying I should rephrase. I'm not saying the markets will crash. I'm saying it could be a catalyst for a crash scenario. Because right now the markets are really, really excited about the prospect of a Fed pause and a pivot. But the problem is that we have, according to the Fed, we still have a ways to go. And if the terminal rate is higher than previously forecasted, at least according to the Fed, then that means that the market may find that they won't pause in March. Maybe they do slow down the rate hikes, but maybe those rate hikes extend further into the year than they would otherwise, and maybe that's going to not. Maybe that's going to delay, the dovish pivot that the market is just dying for. We've already just mentioned the Nasdaq. The Dow made a higher high than August, so that's obviously a big deal. But it looks like it's stalling out a little bit. I do want to call out that this price action, even with the big day on Wednesday, the price action looks like it's starting to crest. So I think that that's something I want to be aware of. It could just go sideways a bit and then continue up. I do want to be aware of the upside risk. Right now, because on a coincident to lagging indicator basis, the U.S. economy is booming still, to use Darius Dale's word that he's been using a lot. I think that's why you're seeing the industrial index, that's what the Dow is, outperforming as it has been. I mean, it's crazy how high this thing has gotten. It's 20% up basically, especially if you go from the wick. The Russell had a breakout from its trend line, so that's something I'm watching right now. It looks like we had a little bit of a retest, and so on a technical basis, I do want to make sure that we're aware of the technicals here. You can't be blind to the technicals, even if you have a bias. You just have to be aware and plan your trades and invest accordingly. So this could be a breakout retest resumption situation. If it does make a higher high than that red wick from Thursday, from the first, then I could see this having a little bit more legs to run. Definitely over the next week, we're in the dead period with the FOMC, so that no FOMC speakers, and we don't have any really truly significant data releases until the CPI on the 13th. So there's 11 calendar days, but 6 more trading days before that data comes out. So there's potential for this to run a little bit into next week and into the beginning of the following week. So I do want to call that out. Now on the DXY, I want to talk about this a little bit because some people have been misunderstanding my views on the DXY. I have been bullish. I have the bullish bias. I feel like over the last couple of months, I've shown pretty clear levels, places where I'm watching risk. Over the last couple of weeks, by the way, I want to just say I was wrong about this level. I thought this level was going to hold as a near-term bottom and that we were going to bounce. I still think we will get a bounce, and maybe this 112 level needs to actually be lower, but I do think we are going to get a bounce, and I don't know if the dollar will make new highs, but I want to mention, and I posted a tweet about this, or maybe I didn't tweet about this, but anyway, I just want to say for all of you watching, on this day back in September, I posted a chart of my DXY before it was with my SAMS indicator, but it was before I had updated the interface and how it looked. But I had posted over here, if you have US dollar trades on, consider at least trimming, if not taking profit entirely. Because we got a really, really big exhaustion signal on the SAMS indicator here. So if I just pull it back up, let me get rid of the table there. So right here, I've called this out a number of times on the SAMS indicator. I've talked about this in my newsletter, which is why you should subscribe. It's free alpha, basically. We came right up into the upper boundary of the range. Now, this range can move, but when you have price moving into the upper range and then the strength signal is showing exhaustion, and heavily overbought, that's a warning sign, and that warning sign has only come a handful of times. Um, and and so, like, I mean, I could just mark really quick. We had it obviously right there. We had that signal there. We had that signal there. We had the signal over here. And that's just in 2022. And the reason why I'm highlighting that is because I want you to be aware that when that signal happened, there is a substantial break that the US dollar takes. So I just want you to be aware, I was 100% ready for price to come off. And so I actually did take profit on, I did take profit on these trades. Um, and and then I can just to kind of, again, I know I don't have to do this, but I just want to, for transparency. Um, I started taking nibbles because I was looking at a consolidation that was something like this, and then at one time it kind of morphed into more of a flag. I think there was a time it was more of a sideways pennant, but I was watching different consolidations, and as we consolidated at these different levels, like, so for example, here on the 4th of October, we sold down, and then the next day we had this engulfing bullish candle. So then I watched the price action on the following candle, and when we dipped down, I took a buy order right there with a stop loss below that level. I just took a little nibble on a couple of the US dollar pairs. And then obviously when price moved up, I moved my stop to break even once I got to 1-to-1. And then I just held it. And then I ended up getting stopped out. And then I basically did the same thing right here on this trade. So on this price action on the pullback, after getting the green candle up, I basically did the same thing. Took a trade with a stop loss. Price moved up, moved my stop loss to break even. So in all of these situations, those trades ended up not costing me anything because I was moving my stop to break even. And then I had this descending trend, or this ascending trend line right here. So I did, because I moved that stop to break even on the huge down day on November 4th. That was a non-farm payrolls day. That was the day where, again, because the unemployment rate went from 3.5 to 3.7%, the dollar reacted really poorly to that. So that came off, and I got stopped out on the 7th. So that was the second time that I took a trade, but the second time I got stopped out at break even. And then because we were coming onto this ascending trend line, once price closed above it, I took a trade overnight going into the November 9th. And then that one, I never got to move that. I never got to move that stop loss to break even. I got stopped out with a loss on the date of the CPI release in November. So ever since then, oh, I'm sorry, I did take one more. When we came down to this level, because I was watching kind of this range right around there. I was watching that because of the support and resistance over here. So I did take another nibble there. I forgot that I had done that. But I got stopped out really quickly because I got too aggressive on the stop loss. I didn't really feel like I had a clear level to go off of, so I was pretty aggressive there, got stopped out pretty quickly. So I've just been on the sideline since. And though my bias has been bullish on the dollar, I don't want you to misunderstand me and think that I've just been blindly taking trades to the upside. They're strategic, and I'm trying to properly manage my risk. And my FX gains this year are over 80%. So, I mean, and that's 80% gains in 2022 on FX at all of the times where people called dollar top. All of the places that people were calling dollar top. And this one might be the top. But my point is that, I continue to stay with what I saw in the macro, and that paid dividends for me. And so, find somebody who has that record in 2022 on dollar trades. I'm sure there are plenty of people out there that had that, but doesn't seem like that was the case by looking at FinTwit. So I just want to mention that. Now, I made a comment earlier about in a bear market. So if we just invert this chart, we think about this, turn the artwork off. If we think about this in terms of like if this was a bear market and we were coming down, if you had a ferocious rally like this, that's pretty normal to have that kind of bear market rally. Because in whatever the prevailing trend is, price typically tends to take fairly orderly walks that direction in a trending market. But then when you have the counter trend moves, the unwinds of positions, short squeezes, or things like that, you get these big moves, these really, really ferocious. In this case, it looks like a ferocious rally, but obviously that chart's inverted. So again, I'm not trying to make excuses and say that the dollar is going to go up and make new highs. However, I think that the problem that we have right now is everybody's convinced that this is the dollar top because price has come off so hard. But you have to remember that, like, look at our main trend line. The prevailing like dollar trend is the overall trend, I should say, that like the most important trend line in the dollar is this really shallow trend line. And until we break that, like, honestly, the uptrend is still intact. I mean, that's on a near-term basis, the trend is down. But on the long-term basis, the trend is still up. And it doesn't matter that, we crossed below the moving average. You know, the 50-day moving average is still above the 100-day moving average. And the 100-day moving average and 50-day moving average is still above the 200-day. And I know that a lot of times the price action will already happen by the time those things cross, but my point is that the overall trend is still up. I mean, like, go ask a 5-year-old if this chart is going up or if it's going down, and they're going to tell you it's going up. It doesn't take a rocket scientist to see that the trend is up. So my point is that just because the dollar has come off pretty substantially, I mean, it's still over 100. And so as hard as it may be to consider the possibility that this might just be a really, really long breather in the dollar, like, you might have to consider that, and you might have to plan for that and position for that. Because again, like, in my opinion, other than the fact that the Fed is going to slow the amount of rate or the pace of their rate hikes, nothing in the macro has changed. They're not pausing. They're not pivoting. And do you believe that the ECB or the BOJ is going to get their act together? And I've been saying that for a long time. And then on top of that, like, all of this dovish hope that people have for the markets, like, you have to think about inflation data. So I have up here the PCE data that came out on Thursday. And it was down below expectation, just like the CPI numbers were. However, on the metric that Powell really cares about is this 3-month annualized basis right here. And I've seen some people calculate this to be at 5. I've seen 5.1. My calculation comes out to 5.2. But in any case, my point is that 5.2% or 5% or 5.1%, whatever it is not 2. And if you look at it on a trending basis over the last couple of months, we haven't seen a 3-month annualized above 5 since the June numbers came in. And so, I think that that's really important to recognize. We're actually going up on a trending basis in the 3-month annualized core PCE. And that's not going to cut it. And so this is the kind of thing that the Fed has to fight. And then on top of that, when you add in the fact that payrolls are still hot, and it doesn't matter what the leading indicators say, the Fed can't make policy decisions based on something that is unknown, and the future is unknown. And so all they see is what currently is or what has been, and they have to make decisions based on that. And that's why Powell continues to say we have to see evidence, like substantial evidence that inflation is coming down. We have to see multiple prints, multiple months in a row that are down and more in line with their 2% inflation target. So that's something that we haven't seen yet. And I just want to point out, I'll just call out Darius Dale at 42 Macro has done a lot of work trying to show everybody that, when you have these declines in like the CPI declines, at the rate of change declines that we have on a month-over-month annualized basis, those types of declines are usually followed by actually a reversal in the trend. So the expectation when you have that kind of deceleration in inflation numbers actually should lead us to expect that next month is actually going to be higher or above expectation. So I think you have to be aware of that risk. And if that is the case, then what do you think the Fed's going to do? Maybe they're still going to do 50 basis points in December, but maybe their maybe their rate hike expectations are going to be a lot higher. And that dot plot, when that dot plot comes out, if the dots are higher, and if there are more dots higher, then the markets are going to react very, very poorly to that. And I think that could be the catalyst that, this is just my opinion, this is my bias, I think that's going to be the catalyst that sends the dollar up. Again, not necessarily saying it's going to make new highs, it could, but I think that's going to be part of the catalyst that sends the dollar back up towards this 111, 112 level, where that might be the point where if you believe that the dollar has peaked, then that would be the place to start to really sell, because there hasn't really been an opportunity to sell the dollar, because otherwise you're just chasing momentum, because this consolidation was not clear. Once it broke down, I mean, maybe right here, but there hasn't really been a lot of chances to sell the dollar where you weren't just chasing momentum to the downside. So that's kind of what I think is coming. Yields broke below the level that I was watching, so obviously that's a big sign. My SAMS indicator is showing a bearish signal. The last time we had a bearish signal was in July and August. Of course, you know what happened there. And just for the sake of showing it, this consolidation from the near-term peak to the low took 48 days, 34 trading days, 48 calendar days. And from our closing high, it's only been 29 trading days, 39 calendar days. And so this can consolidate for some time before going back up. I'm not saying it will. I'm not saying it's going to make new highs, but like find somebody out there who, like, I can go find the tweet. Go find my tweet. I would challenge you. Go find my tweet that happened on either August 1st or August 2nd. I can't remember which day it was. It was right here. I said bond yields were going to make new highs, and they did. This is the part where everyone was saying, "Oh, there's a head and shoulders. It's going to crash down, and it's going to, yields are going to go back down to below 2%." And look at what happened. So again, and I made that call because of the macro picture. And again, I don't really believe, other than, again, the slowdown in their pace, I don't feel like there is any substantial evidence to show that the Fed is actually materially changing their policy. And honestly, it's the Fed that matters. That's all that matters in that. So I think that that's something to be aware of and something to watch. Gold, I made a bad call here. It turns out that gold stopped. If you have a 100-day exponential moving average, I usually use the simple moving averages. But if you use the exponential moving average, it actually it retested that 100-day simple exponential moving average. So it actually looks like gold is going to run a little bit. But what I'd like to see is gold substantially over 1807. If you were on this channel earlier this year, I talked a lot about this range between 1875 and 1807. And I said if we're in that range, if we're in between those levels, that's no man's land. If we're below, there's a bearish bias. If we're above, it's a bullish bias. So we're knocking on that range right now. So I think that that's something to be aware of. If things take a turn for the worse, if inflation data doesn't behave, and if the Fed comes off really, really hawkish, then we might see this come back off. Or maybe now is the time for gold. I think the big thing with gold is, are we still going to be having growth? Because gold thrives when there's no growth. And so I've suspected that people are buying this because a lot of the leading economic indicators are saying that the economy is slowing and falling off a cliff, and everybody is also believing that the Fed is going to slow down, pause, and pivot relatively soon. And that's the type of scenario, if you think growth is coming off, but then you think the Fed is going to ease, that's where gold will fly. So I think that's where the bid in gold is coming from. So if anything happens which changes that narrative or that trajectory, then that's where I think, gold can come back off. And I'll be watching the range between 1704 and 1736 as a potential spot to catch support if we do have another move down. I think that's going to be a good area if you're thinking about longs again, if you missed this opportunity. And then crude oil, again, made another low, although on a closing basis, we didn't close below our last lows in September. But oil is having a really, really hard time. Every time there's a potential China reopening rumor, it bounces and then it gets sold off really quickly. So we'll see what happens next week. Next week is supposedly when the price cap comes in, so we'll see how oil reacts to that kind of news and what Russia does in response, if anything. But for now, I've talked long enough. Thank you for tuning in. Thank you for watching. I hope you guys have a great weekend, and I will see you guys next week.